All right, so there's been a lot of buzz surrounding the stock market as the S&P 500 and the Dow just hit record highs this last Friday, and that's left a lot of investors and speculators wondering what's going to happen next. This latest rally of the stock market comes a little less than 2 years after the Fed started raising interest rates as a result of the pandemic-induced inflation, which sent the stock market into a bit of a downturn. And like I said, many of us are wondering what's going to happen next. Has the Fed's policy allowed us to avoid a recession? Is this just a brief uptick before the real downturn hits? Should I invest my money? Should I just save my money? You may be telling yourself, I just don't know what to do. And to be completely honest, I do not have the answer to a lot of those questions. But I actually really don't think that anyone else knows the answers to those questions either. We'll get to that later in the video. But for now, just know that the stock market is an unpredictable beast that people will spend their lives trying to time and predict perfectly. And the reality is that most of them fail. But while that may make you concerned, don't be. In this video, I'm gonna go over a couple points on the stock market that will make it easier to manage in 2024. And I'll also cover my own philosophy on how I handle my own investing. Oh, also, and if you haven't already, make sure you hit that subscribe button. I'd really appreciate it. Thanks. But before we dive into the meat of the content, I have to add the disclaimer that this is not specific financial advice. And I am not a certified financial advisor. I'm just someone who's really into personal finance, invests myself, and has learned a few things along the way. But I won't be recommending any specific investments I think you should make. And before you ever invest in anything or really listen to anyone about personal finance, including me, you should also do your own research and if necessary, make sure you talk to a certified financial advisor. All right, my first piece of advice is turn off the news. Okay, not literally. I know it's always good to stay informed, but you need to find a way to not let the headlines emotionally impact you. Really in anything, but especially when it comes to investing. Just since the S&P 500 hit its record high, I've already seen tons of articles talking about how the stock market is gonna have the biggest rally ever and that you shouldn't miss out. And at the same time, I've also seen countless articles that are super doom and gloom, saying the recession's coming, saying that this is just an uptick before the stock market's about to crash. So there's a lot out there both ways, and that's not new to right now, that's always out there. And the truth is, either side could end up being right, or both could be wrong. There's so many possibilities and no one really knows what's gonna happen. A lot of what the media shares when it comes to investing and personal finance is trying to trigger some emotional response from the viewer. It's not actually a logical take of what people should do. And because of that, I've seen so many people get scared away from investing. They read these headlines, they get worried, they don't know what's gonna happen to the stock market, they're worried there's gonna be a recession and that they're going to lose everything. In fact, here's a comment or a statement I see online all the time. I lost my entire stock portfolio in the recession caused by the great financial crisis in 2008. Okay, so let's take that statement and let's break it down. During that recession, the US stock market dropped by about half of its value, which don't get me wrong, that is a huge drop. But let's look at the absolute worst case scenario and say at the perfectly wrong time, you panicked and you decided to sell all of your stocks. Well, worst case scenario, you lost half of your money. Not great, but not quite as dramatic as losing everything. I also know a lot of people lost their homes during that recession. That obviously does not apply to them. I know there were a lot of hardships, so just wanted to point that out. But back to our example, let's say you stayed patient. You stayed the course and you kept your investments how they were. Well, your investments would have completely recovered just a few years later. And today, those same investments would be worth 4 times their value from right before the Great Recession. So we always hear horror stories of the stock market crashing and people losing everything. And that scares a lot of people away from the stock market. But in reality, it was really only the people who panicked and sold out who ended up losing something in the long run. All right, my next tip is to keep it simple. The next biggest mistake I see people make when it comes to their investing is that they try to overcomplicate everything. And this usually happens because people invest in individual companies and they try to pick their own portfolio, rather than just investing in something like a low-cost index fund. And people usually do this because they think they can get a better return on investment if they pick their own stocks versus just investing in something like an index fund where the stocks would automatically be diversified for them. And if you do decide to go out on your own and build your own portfolio, you are almost guaranteed to underperform the S&P 500. According to the 2021 Spiva report, 94% of professionally managed investment funds failed to perform the S&P 500 over a 20-year period. And keep in mind, these are professionals. These are not everyday people. If professionals cannot be index funds, what makes people who don't work in investment banking think that they can? And the answer is just that they would be much better off just investing in a passive index fund. Investing does not have to be hard. There's so much education out there on how to pick a good, solid index fund that's best for your scenario, but you don't have to pick your own stocks to look cool to your friends. It's always best. Just keep it simple. All right, another huge common issue is when people try to time the market. And honestly, this may not be intentional with most people, but human emotion tends to want to invest in something when it's going up, but is afraid of investing in something when it's going down. Everyone loves the saying, buy low, sell high, but most people actually let their emotions get in the way and they end up doing the opposite. They buy into something when it's growing and it's trendy, and then they want to get out when the bubble pops, and they end up losing money because of that. But keep in mind, the opposite is also bad. You also do not want to hold off from investing in hopes that you'll get in at the bottom and ride the wave up. Because, like we already said, the stock market is almost impossible to predict. And if you sit there waiting outside of the market, you actually may miss the best wave of investing. You never know when you're going to miss out. So the key is to not try to time the market in either direction. You don't want to try to time it to buy low, and you definitely do not want to time it to buy high. Instead, it's much better to do something called dollar cost averaging, which essentially means that instead of trying to time the market and doing one lump sum investment all at once, you instead invest a smaller set amount at regular intervals over a long period of time. That could be weekly, bi-weekly, monthly, or at another interval that works best for you. If you're contributing to a 401k and that's automatically being deducted from your paycheck, that's a great way to dollar cost average. You're investing a set amount every paycheck, and that is accomplishing the same thing. And we're going to talk about the theory behind it in a second, but I also think dollar cost averaging is just a great way to manage your emotions because it gets you in the habit of investing regularly. And because it's just a habit and you do it no matter what, you won't psych yourself out if the market takes a bit of a tumble. So let's look at this graph. This graph isn't tracking anything specific. I just needed a chart that went up and down so that I could illustrate my point. But let's just say that this is for a specific fund that we wanted to invest in. And let's say we have $10,000 that we want to invest. What would be the best time to invest that $10,000? Yep, right at the bottom, because then you buy it at the bottom and then you immediately get to see your investment grow and go up. What would be the worst time to buy into this fund? Yep, right up at the top, because then you're going to buy into the fund and then you're going to see an immediate decrease. So just buy at the bottom, right? Well, no, we just talked about this is almost impossible to predict, and people are usually worse off for trying to time it in that way. So instead, we could manage our risk by using dollar cost averaging, where we would take that $10,000, split it up into increments, let's just say $1,000 for this scenario, and we would just invest it at 10 different points along this graph. So we're investing as the chart's going up. When the investment dips down to its low, we're investing during that dip, so we're taking advantage of it. And then as it continues to go back up, we're taking advantage of that growth, continuing to invest. And we're really just removing the risk of trying to time the market, and we're just investing over time. All right, my last tip for investing in and navigating the stock market is to start as early as possible and do it for a long time. As they say, time in the market will always beat timing the market. And this is because of compound interest. Compound interest is when your money grows exponentially due to the fact that your money earns interest, and then over time, that interest earns interest, and so on. And although annual investment gains may seem kind of small in any given year, over time, they can grow into something absolutely mind-blowing. So for example, let's say you invested $10,000 at an 8% return. After 5 years, that would be worth roughly $14,000. After 10 years, $21,000. After 20 years, $46,000. At 30 years, it'd be worth roughly $100,000. At 40 years, it'd be worth $217,000. And at 50 years, it'd be worth $469,000, which is crazy. Notice how every 10 years, your investments pretty much double with just an annual return of 8%. And I hope that drives home another point, is that every year you wait, it's another year that you're delaying this compound interest from starting, which could result with you losing out on hundreds of thousands or even millions of dollars. So again, get started as early as possible and keep going. But that's gonna do it for the video today. I really do just love the topic of investing, and I just feel really passionately that most people need to cut out the noise. They need to simplify their investments, and they just need to do more of it. But if you like this video, make sure you hit that like button. If you haven't already, make sure you subscribe to the channel as well to see more videos just like this, and I'll see y'all in the next one. Thanks.